Hi, good afternoon, everyone. Today we'll be discussing Ind AS 34 interim financial statements. Interim period. Period is what are interim financial statements? Where those are the financial statements where the period is less than 1 year, say quarterly or half yearly or monthly. Quarterly results are as per SEBI regulation LODR, listing obligation and disclosure requirements as per regulation 33. It specifies minimum content for the interim financial reporting, principles and measurement of recognition of interim financial reporting. The above 2 points A and B are applicable to listed entity only. The SEBI regulation gives waiver to the listed entity. The Ind AS 34 requires the entity to prepare the following: condensed P&L, condensed balance sheet, condensed cash flow, and condensed SOSI, selected notes and significant information. The full set of financial statements are governed by Ind AS 1 presentation of financial statements. Significant events and material items in condensed statements: write down of inventory, impairment of financial assets, reversal of any previous provisions, acquisitions, capital settlement, contingent liability, any default in loans, related party disclosure, other disclosure. Same accounting policies have been followed as compared to annual accounting policies. Change in estimate, issue of shares, dividend paid, business combination and loss of control, fair value disclosure of financial instruments, materiality. Tax rate of the full year is to be applied on the quarterly results. If it is foreseen that the tax rate for the full year is 26%, the corporate tax rate is 30%, and there is a profit of 100 crore in Q1, then the following is to be applied. Tax 100 crore into 26%, that is 26 crore. Example, the company has reported a 60,000 crore pre-tax profit in the first quarter and expects a loss of rupees 15,000 crore in each of the subsequent quarters. If the corporate tax rate is 20% for the first 20,000 of annual earnings and 40% for the additional earnings, profit for the full year would be Q1 60,000, Q2 minus 15,000, Q3 minus 15,000, Q4 minus 15,000. Total profit for on an annual basis will be 15,000, and tax rate of 20% would be applicable. So in Q1 60,000 into 20%, 12,000 would be the tax rate, and in Q2 minus 15,000 into 20% minus 3,000 would be the tax amount. In Q3 minus 15,000 into 20% minus 3,000 would be the tax amount. In Q4 minus 15,000 into 20% minus 3,000 would be the tax amount. The total tax amount would be 3,000. If in the above example, Q1 the total profit for the year is expected to be 55,000, and in Q2 the projection of annual profit reduces to 15,000, then show the impact. Uh, uh, s- uh, s- in Q1 20,000 into 20%, 4,000, uh, plus 35,000 into 40%, 14,000. Total is 18,000. 18,000 divided by 55,000 into 100, 32.72%. So in Q1, 60,000 into 32.72%, 1966. If in the Q2 the projection changes to 20% for 15,000 annual profit and the loss in Q2 is 15,000, then in Q2 60,000 minus 15,000, Q2 loss into 20% into 20%, 9,000, uh, 9,000 tax 19,636 minus 9,000, 1066, hence Q2 there would be a reversal of 1036 uh, uh, in the tax impairment. In case there is an impairment loss in Q1, the same can be reviewed in Q2. However, impairment of goodwill cannot be reversed in the subsequent quarter. That brings us to end of the session. Please do like, subscribe the channel. Thank you so much.